we're live. We're live. Good. Can you hear me, Nat?
Yes. Can you hear me?
Hi, Tim. Yeah, good. Hi, Tim. Good evening to you. Nice to see everyone. Thanks so much for joining. Hey, everyone. We're getting a few highs, which is very cool. I'm Kristen, and I am the general manager of Hatch, and I'm joined by Natalie, who is the head of customer. Say hi, Nat.
Hi.
Of Hatch. So if you are Hatch users, if you've signed up, which I think many of you have, Nat has basically designed Hatch from scratch, every single little touch point. So she's designer guru, an investor from a long time. She'll talk a little bit about her story. I've come from a bit of a tech startup background, and I was approached by, good evening, hi everyone, so nice to have your hellos. Sorry, I'm so chatty. I'm easily distracted too.
We just keep saying hi to people.
That's what my report card said when I was little. But look, I joined Kiwi Wealth a couple of years ago, and I was given a challenge. Kiwi Wealth is part of the Kiwi Bank family, the Kiwi Group family, and was given a challenge. How might you how might you modernize wealth and develop a wealth platform for people to engage on their own terms in their own time and treat everyone like an individual that they are. So there's not a cookie cutter approach to building wealth. Anyway, I recruited a bunch of fantastic people, one of which was Nat, a number of really intelligent tech people, and we built the very first iteration of Hatch. We spent hundreds of hours chatting to Kiwis, everything from 20-year-olds to 60-year-olds, and chatting with them about wealth and what wealth is to them. Good news is that it's actually not about getting rich, and it's not about money, but it's actually about living the life that we want to live, financial freedom, but also having a sense of self-expression. So if that means that I want to back the things that I believe in, or I want to invest in companies or causes that I really care about. It also means that I have a balance in my life, so I'm just able to make choices. I could quit my job, or I can go traveling when I'm older, and that I'm healthy. And so there's this real sense of balance in New Zealand, which is fantastic. And we wanted to provide a community that came together that held those similar beliefs. So we when we were interviewing people, it just felt like options in New Zealand were quite, everything was the same. Things felt kind of done and tired. And so we thought, well, there isn't access to kind of one of the most exciting share markets in the world, which was the US share markets, where you can really back and build a portfolio that reflects who you are. And so we found a fantastic partner in the US, and built the first iteration of Hatch, which is access to the US share markets. So that's what Hatch is today. We offer access to over 3,000 US listed shares. There are also some foreign shares on there called ADRs. Happy to chat about those later. And what it does is that we're offering Kiwis a fresh new way to invest on their terms, in their time, to build a portfolio that truly reflects who they are. So, we fervently believe that Kiwis deserve to up their wealth. We have lots in store for the Hatch platform. The US is really just the first of many cool things. And we've got a fantastic Kiwi Wealth and a Kiwi Bank family behind us that we can leverage from. So we've got access to experts. We've got access to really cool products in the future, all sorts of cool stuff. So that's kind of the Hatch story. We've had a really busy lockdown. The markets were pretty crazy. As a result, a lot of people wanted to get in off the sidelines. I think we've been chatting for some time about what might a market crash look like. Certainly the minute we launched Hatch, everyone was saying, ooh, the markets are going to crash, markets going to crash. Sure enough, 18 months later, they did just that. That said, they have recovered to a large part, but certainly a lot of people came off the sidelines. And so we've been very busy. We've grown the team over the lockdown. We have a fantastic team of 20, and we've got some pretty cool plans in store over the next year or two. So thanks so much for joining. Tonight, really what we're going to do is answer some frequently asked questions. So we've got some that people have sent us beforehand. We also know of some that are really obvious questions that people ask Hatch. We'll chat a little bit about investing. Nat's going to chat a bit about the product. But what I'd also like to invite is the comments, where you're all like chatting and looks so friendly. Hey, Sarah, some great people here. We've got our families online. That's cool. Please feel free to ask questions in those comments because we'll interrupt ourselves. Nat and I are known extroverts, and we'll just talk. And I can't see your faces. I can't see if you're bored. I can't see if you need us to stop. So please, this should be interactive as a digital interaction can be. So we'll read your comments. But I think we'll probably crack right in. Hopefully I gave a little bit of a background of Hatch. I just want to talk about why investing. Why would you even sign up to a platform like Hatch or consider investing? And it's simply because historically the share markets have shown to be one of the best places for your money to work. I think in the last decade, we've had the share markets, the US in particular, grow on average 12 to 13% a year. And so those are pretty solid returns. Now, naturally, there have been some bumps on the way. Last year was an amazing year. I believe the share markets were up just over 30%. That's pretty incredible. And then, of course, we know what's happened this year. Big drop. That said, we've also seen a big recovery. Yes, there's going to be volatility. We can chat about that a little bit later. But I suppose really the why invest is because it's the best way to grow your money for the long term. Now you get to decide where and how you do it. And so we're here just as an option. That's going to talk a little bit about that. We're not here to answer financial advice. So just obvious disclaimer is that anything we talk about tonight, be it shares or strategies, you've got to find what works for you. And if you want to talk to a human being about that, financial advisor is a great place to start to do that. So no financial advice, but we'll just talk in general terms. We'll talk about kind of industry, general best practices and what people are doing on Hatch and what our community is doing and what we've learned from them. So why invest is, again, just a fantastic place to put your money to work. Let's assume that you've got some of your credit card debt sorted, student loans kind of sorted. You've got some emergency savings put aside. What we found in a lot of our interviews is that too many Kiwis just kept their money in savings or in TDs, and it certainly isn't doing anything for you at the moment. So by having money in the share markets, while yes, it may be volatile right at the moment, over the long term, share market, your money tends to ride the ups and downs and on general go up, as we've seen in the history of the share markets. So it's a really great place to have your money. And we can talk about some strategies, of course. Investing and stock market 101. For those that don't even understand, what a stock is a company that's looking to raise money, and they effectively sell a portion of their company. By doing that, they issue shares, and they need to sell those, put them on a market because they want people to buy them, and so they can then take those funds to grow their businesses. So it usually means that a company is looking to take a step change in their business, and there's a couple ways they can do that. They can borrow money from large institutional bank. They can get money from venture capitalists. You see these big raises of Airbnb and so on, or they can go public, and so they list in what's called an IPO, initial public offering, and they offer shares up for everyday investors, you and I, to invest in those shares, which effectively is we're buying a small slice of those companies. So on Hatch, you can invest in over 2,900 individual companies, US listed companies, from the likes of Nike to Facebook, Tesla, Microsoft, you name it. We'll chat a little bit more about those. But what that means is that as the company grows in value, their share price reflects that company goes well. And if it's growing, naturally over time, the value of that share will go up because the share price will go up. Another way to make money off shares is dividends. So a number of companies, now not growth companies, because growth companies don't want to pay you money because they want to reinvest in their business as a big land grab and actually grow their businesses quickly. So quite often you'll find that growth businesses don't issue dividends. But a number of blue chip companies, what they're called, so these big, steady companies that are earning money, typically those that Warren Buffett likes to invest in, they offer dividends. And so it's basically a thank you. They give you a split of the profits and share those amongst their investors every quarter. So again, a couple ways to make money off companies is that you buy shares in the company, the share price goes up in value, and at some date in the future, usually with the share markets, they say, don't invest unless it's at least 5 years is kind of the going. But people naturally, if it's a few strong years, I think the point is you don't want to have to get out now. So point is that after 5, 10, 15 years, that share value is now worth a lot. If anyone wants to just take a look at Amazon, the share of Amazon, and what that's done over the last, I think, 9 years, gives you a good idea of if we had owned Amazon at the very beginning, and how much and how many shares and how that's worth now. And so you sell those in the future and you've made some money. Secondly is the dividends, again, as I'd mentioned. And the other thing you can do on Hatch is invest in exchange traded funds. And what those are is that a fund manager, like a Vanguard, for example, bundles a number of companies up into basically a basket. And then you can invest in the fund, and your money is spread out across all the companies inside that fund. So you can get anything from the S&P 500, which is investing in the top 500 shares in the largest 500 share companies in the US, right down to being very specific, an exchange traded fund in gold, exchange traded fund in cannabis or cannabis industry. So if you don't want to make a bet on a single company, exchange traded funds basically grab a swath of that, be it sector or industry or commodity, and you're basically diversifying, spreading your money out over a number of those things. So we've got over 450 exchange traded funds, and again, that's just a fund that's listed on an exchange. Some of them track indexes, which is basically a benchmark. So the S&P 500 being the most popular, that is a fund that tracks the performance of the top 500, largest 500 companies in the United States. Probably one of the most popular funds here in New Zealand is that one, and probably on Hatch as well. The other popular one being the NASDAQ 100, and that is a fund that tracks the 100 largest technology companies in the United States, another very popular fund. So those are the couple of the ways that you can invest through the stock market. And I think I'll leave it there because I'm going to pass it over to Natalie, who's going to chat a little bit about key investing concepts, about jargon, about how people are investing on Hatch, and then we'll probably crack into some FAQs.
Cool. And I have seen there's one question, so keep them coming. And also, everyone make sure you're on jargon alert. So if we work in finance, we try as hard as possible to strip out any sort of jargon. We hate it, but every now and again when you're in it all day, things slip out. So if you do hear any words that you don't understand, absolutely just put them in the comments and we're more than happy to explain them. A couple of years ago, we probably didn't know most of them ourselves. So there's no, and there's always something new. There's always new jargon to learn. So let's start with some key investing concepts. So one of the things that you probably hear about a lot, and this kind of talk can be a little bit tricky because we know that we've got a whole range of people with a whole range of experience. So for some people, this will be very 101. For some people, this is kind of all new. So bear with us while we cover everything off. And once again, use the comments to tell us if something's boring and you want us to move on. So let's start with trading. And I think trading is a good place to start because it's that kind of Wolf of Wall Street, that old style kind of buy, sell stocks, get rich quick. And as Kristen mentioned already, that is quite a different philosophy than investing, which is what Hatch is all about. So trading basically is the concept of the companies. Kristen talks about the stocks, the shares in the company. Basically, traders try and guess the top and bottom price of those shares. So they want to buy shares at a really low price and sell them for a high price. So they're sort of playing this short-term game to try and game the market. Whereas investing kind of is quite different from that, where it's you actually look at a business or a fund, like Kristen's talked about, exchange traded funds, an industry, a trend that you really believe is going to be big in the future or is going to continue to grow, and you invest in that business. You own a slice of that business or a slice of a bunch of companies in that industry, or a range of different types of ways to do it, but you've really sort of gone in and you're backing something you really believe for the long term. And those, while the actual mechanisms of doing both those things are very similar, there is such a fundamental difference between those. When you're trading, a lot of people do it and a lot of people do it successfully. Many people don't do it successfully. And that's kind of that get rich quick, that kind of gambling style for a lot of new people way of investing. And other than all the consequences of making a bad decision and not always getting it right, one of the things that does do is put people off. If you start doing that really early on and you make a couple of bad decisions and lose money, you quite often blame the share markets for that. And that's why they have a reputation, in New Zealand especially, for being quite a high-risk place to put your money. In the 1980s, a lot of Kiwis were taking out loans to invest in the share markets and trade and try and make a quick buck. That's absolutely quite a different philosophy from investing. Then I'm just going to quickly cover off, when you're thinking about investing, some of the kind of key terms and that we like to talk about a bit. Firstly is this concept of pay yourself first, and it's and actually when we sent out the pre-survey, quite a few people said they'd already really knew this concept inside out, but I think it's worth mentioning again. And the concept of pay yourself first is basically the concept of valuing yourself and your future. And awful books like Rich Dad, Poor Dad have it. Good books also talk about it. A lot of investors talk about it, and it's so simple. And I think what you'll hope to learn tonight, if you are new to investing, is that actually most of the best concepts are actually ridiculously simple, and so that's often why people overlook them. Very similar to how when COVID became a thing, people couldn't understand how washing your hands could actually be the solution. Sometimes the most simple investing philosophies are the best. So paying yourself first is very much literally when you get paid, you take that money out immediately. Often people set up an automatic transfer. So before that money hits your bank account and you see it and you mentally spend it, it's gone and it's out into your investments. And there's a couple of big benefits of that. It seems so ridiculously simple, but the biggest benefit of that is it's invisible to you. And the reason why that's a big deal is humans are very good at looking for short-term benefits. So if you've got that $100, $200 a week sitting in your bank account, you will spend it on things that bring you great immediate joy. And then at the end of the week, when you don't have much money left, you're not going to go out of your way to try and figure out how to make up the gap to invest it. Whereas if you invest that money first and at the end of the week you don't have the money to pay for a dinner out, you'll probably figure out a way to do it. So that is kind of a pretty important psychological trick you can play on yourself to make sure you actually get into good money habits. And with Hatch, it's very easy to just set up an automatic payment, set and forget it into Hatch, or any other investments, very similar to KiwiSaver. It's taken out of your pay before you even see it. The second part that sort of goes hand in hand with that is the concept of dollar cost averaging. Again, quite a few people have told us they understand this concept, but it is very much the idea of not trading and not trying to time the market. And so I'll talk a little bit about that, as well as our concept of buy and hold, because they once again kind of go hand in hand. So dollar cost averaging basically removes the guesswork and the trying to use your smarts to outsmart the market. So that basically means you pay yourself first that $100 a week or whatever, and you invest that every week or every month or every 3 months or every 6 months, whatever your time frame, and you just invest that same amount in the same investments over time, and their prices will rise and lower over the short run. When the prices are lower, you buy more shares. When the prices are higher, you buy less shares. Overall, for most set and forget investors, people who just want their investments to work behind the scenes, it pays off more so than really spending the time analyzing the highs and lows and when exactly is the right time to buy. And then I suppose the last kind of 2 points I want to make on sort of the key investing concepts is, and I'll only touch on this lightly because I think we'll go into it more later with some of the other questions, is starting small. As with like Kristen said before, people often talk about investing being 5 to 10 years plus, and that's kind of a rule of thumb, but really the reason for that is you never want to need the money back. That's where people get into strife. So let's say you start big and you invest $10,000 and you're left with no money in your bank account, then your car breaks down. You're forced to sell your shares and get what you can with that money to pay for the car repairs. You don't want to be in that position because that means you're at the mercy of those short-term fluctuations. What you really want to do is to be able to say, fine, I'm just not going to use that money for the next couple of years. I think a lot of people fell into this trap when the markets dipped recently, and the KiwiSaver was in a growth fund and they wanted to take it out for a house deposit, and suddenly 10, 15, 20% of the value of their KiwiSaver was wiped off, and they felt that they needed that money in a hurry. But if they're happy to just delay buying a house for a year or 2 or 5, whenever the money bounces back, you've actually not managed to get yourself into a position where you've lost money. And I think, yeah, starting small really ties in with that, is you just don't want to go in too quickly and make a big loss, or learn your mistakes with a lot of money, because that's when people really get put off, and they never come back. And it's such a shame, because you've missed this great opportunity to learn as you go. Is that kind of the main concepts, Kristen? You got anything else to add, or should I just move on?
Yeah, no, we've got lots of questions to come. So
cool.
That's good. Should I give a crack at answering 2 of these questions?
Yeah. Do we want to go into how?
Yeah, cool. Yeah,
we come back.
Yeah, I can chat currency valuations and ETFs, and then you can chat on the other ones if that's good. Shall we do that? Okay. So U.S. shares has risks in currency fluctuations. So people, that is a question we get asked, and how do we protect against that? So that's a concept called hedging, and that basically means that as there's if you have a fund that's hedged, if the US dollar changes massively one way relative to the New Zealand dollar, this investment actually protects that and invests in an inverse way. So you're effectively not at the whims of currency market fluctuations. And so all you have to worry about is the returns on your investment that don't get eroded, or the other way around. Actually, you could be up on the other side. And we don't currently offer any hedging products. But some funds in New Zealand do, but not all. So an example would be if you are investing in smart shares, those products aren't hedged, but you wouldn't know that because everything's in NZD. So a lot of people that invest in smart shares feel that they are hedged. And the reason that a lot of the funds that are available to us on the share markets, exchange traded funds, aren't hedged is because they're expensive. It costs money to do that. You're basically paying someone to develop a new strategy inside of that fund. And so people do pay for it, and you can do that. So you can go and seek out a hedged product that exposes you to the US share markets. But what they have found that over time, over the long run, 5 years, if you were to compare the returns of hedged and unhedged product, it kind of balances out. And they're finding that, I've read a few studies that actually one doesn't come out far ahead at all. So it's almost trying to, again, think of the long term, ignore short-term fluctuations. If you're really concerned about it, find a hedged product, but you will be paying for that. So over the long run, analysts have shown that actually at the end of the day, it kind of all averages out. And so we've talked about that, the cost, and that it averages out in the long run. Don't think about the short-term fluctuations. But another thing, I suppose, is we talk about with Hatch and why the US share markets is diversification into another market and into another, you're actually holding some USD. So naturally, this is one step removed from hedging. But the fact is that we live in a very tiny economy. Our share market is, the size, the market capitalization, which is, just think of it, the value of the entire New Zealand stock exchange is the same value of one tech stock listed on the US share market. So if anything, that just gives you a pretty good example of how, or indication of how small we are, here at the bottom of this earth with this tiny economy, and diversifying in outside of New Zealand into a larger economy and holding some USD isn't necessarily a bad thing, which is why we wanted to give access to this market to begin with. So I hope I answered that question, and I'll just quickly go.
One last thing to that.
Yes.
The thing with foreign currency, especially New Zealand versus versus the US, is we generally fluctuate between 1 New Zealand dollar is worth 50 US cents and up to like 80, 90. So that's about a 40% fluctuation, which in the short term, you're like, oh, this has just dropped and I've lost 40% of my value. I've put 100 New Zealand dollars into some shares in the US, and then because the price has changed of that currency, I've lost 40%. But when you actually think about 40%, and that's the maximum really it ever changes, in the context of, as Kristen said earlier, basically on average, 10 to 13% returns a year on your shares, takes 4 or 5 years, and any of those currency fluctuations are basically wiped out anyway, even if it went wildly in the other direction. So there is actually a limit to how much currency can really impact. So yeah, it's not something, it's one of those things that it feels complicated and it then can become an emotional barrier because it feels easier to just see everything in New Zealand dollars. But it's definitely one of those things that it is worth absolutely having a read up about it. And we'll probably try and find some of those links to how hedging works and why it does or doesn't matter. But it's definitely not worth being a barrier to getting started. It's that to me feels like it's much more of a mental block that people have because it looks complicated, but it's not as complicated as you'd think.
Cool. And then I'll just tackle, from my perspective, pros and cons of exchange traded funds versus companies. We think that it's not an or situation, but it should be an and. I can only guess that probably everyone watching this has got a KiwiSaver. So you are largely invested in funds and companies inside a KiwiSaver scheme. So think of that as a fund. You're very well diversified inside of that KiwiSaver scheme. And then if you are looking at now investing outside of your KiwiSaver, outside of property, you do have those choices. You've got managed funds, which effectively are built and actively managed by human beings, which is why they have slightly higher fees associated with them. There's lots of those on hand. With respect to exchange traded funds, they tend to be a little bit cheaper because most of them tend to be indexed or not actively managed. So that just means that they kind of track something, be it tracking, the 500 largest companies in the US or 100 tech companies or 100 cannabis companies. There's kind of rules, and then they just kind of track to those rules. So exchange traded funds, the pros of those is immediate diversification. So usually when people on Hatch or on share trading platforms are investing, they tend to put anywhere between 60 to 80% in those funds. And that's kind of the set and forget. And that can be as little as 2 exchange traded funds. In fact, I think it's Warren Buffett that says just put everything into US 500 and just forget about it and consistently put it in. So that's his strategy is 1 fund in kind of that core. But anywhere from kind of 2 to 3 funds can set you up as like a really solid core strategy. And the benefit of that is that's the set and forget, really well diversified. If one company does badly or one sector does badly, it doesn't matter because you spread your money across a number of them just by automatically investing in exchange traded funds. And then I suppose the pros of the companies and why a lot of people do that is they're trying to pick companies that they believe in. This is where the personalization and the control in your portfolio comes into. So if you really believe and feel that technology and you use Microsoft products and you're using Teams at work and you see all these cool, the future of this business, you actually want to invest in that business because in all likelihood, the hope is that it's going to outperform kind of that broader market and those broader funds that you have. So there's this kind of idea of that you're picking these little picks on the side that really shouldn't form more than 10 to 20% of your investing in areas that you really back for the future that are going to grow. And so the benefits of the companies is that the potential to gain more is higher than in a diversified fund, but also the potential for it to go up and down as well, and which is called volatility, is also higher. But again, you get a sense of control. You're backing something that that's personal to you, and of personalization as well. Nat, anything to add to that one?
Yeah,
diversification. And can you? Yeah, sorry. Go ahead.
So diversification, it's basically spreading your eggs across many baskets. So the concept of diversification is pretty simple. If you put all deposit $10,000 into Hatch, you put it all in Apple, then your money is 100% dependent on the future of Apple. Pretty cool, pretty big company. Nothing's ever guaranteed. So you've got all your eggs in one basket. Diversification basically means you spread that $10,000 out over 5, 10, 20, 100,000. Some of these exchange traded funds have thousands of companies. So even if a handful of them go bankrupt, it's such a small percent of the money you've got invested that it really, really minimizes the impacts of that. So it kind of just gives you, it's a way to de-risk investing or lower the risks of investing because you've spread the money out wider, so you're not dependent on any one thing. Yeah, a couple of little additions I'd make to that. Kristen mentioned the US 500 fund, and I just wanted to clarify for anyone who doesn't know what that is. Vanguard and actually a few other companies, fund managers, basically try and replicate what they call the Standard & Poor's or S&P 500, which is the 500 biggest companies in the US, listed in the US. And the reason why this fund is so popular, the Vanguard one, and like Kristen said, Warren Buffett mentioned it by name. Warren Buffett, for everyone who doesn't know, is one of the kind of, in investing circles, known as one of the greats. He has his own company and it's had very good performance over the years. So people kind of look to him as someone who's pretty... Except
for this year. I don't know what's going on, Warren.
He invested in airlines. And the reason that 500 companies is used as a general guide, and the reason why those funds, I think if anyone's interested, it's the Vanguard, VOO is the ticker symbol, the Vanguard S&P 500 funds, the one Warren Buffett mentions, is that once again, those companies tend to reflect kind of the overall performance of the entire share market. So what that means is because I think they generate about half their revenue internationally and half from the US, they are just such a good indicator of if the economy is doing well, your share price will go up. If the economy is going down, their share price will go down. So over the long run, the assumption is share prices will always increase. And the great example we use when faced with some of these big life events like we've had recently is last century we had, multiple global wars, Great Depression, all sorts of stuff, and the economy at the end of the century was much better than it was at the beginning after all that. So the US 500 or S&P 500, it's worth looking it up and understanding that kind of little bit of jargon because it's quite a useful standard that most people sort of tend to, even when it comes to investing in your portfolio, most people tend to check to see how well they're doing versus that. So you sort of look and go, have I done better than just if I just put my money in these 500 companies? And it's good, kind of... Yeah.
It's a good indication of the overall US share market.
So
yeah. You just want to Google it and see how that kind of index has gone, the S&P 500. It gives you a good idea of what the US share markets have done over the last 90 years. Yeah. Because it makes up, again, the largest, probably 40% or more, well over that actually, of the US share markets is kind of in that basket. In fact, 40% is the large tech behemoths that are in that basket. But one thing to note about the VOO, that particular fund, is that the expenses and fees are really important when you're investing. So when you're signing up to an investing platform or you're investing, make sure that you're investing kind of expenses, so how much you're spending to invest. So that means from any subscriptions or brokerage fees or the actual underlying fund fee is under, people like to keep it around 1 to 2%. Under 1 is amazing. Under 1%, that would mean that you're kind of doing more lump sum. So you're saving up a bunch of money and then investing at a time, one time to keep your fees down. But kind of keeping your fees down is pretty important because fees kind of eat into your returns. And so that particular fund, I think, is like 0.03%. So 0.03% of your money is going to the fund, the fees of that fund, which is, incredibly low.
And I think funds that are listed in New Zealand that invest directly into that, their fees by comparison, I think are over 0.3, so 10 times as much annual fee, which when you've got a small amount invested doesn't mean much. When you've got larger, that's the number that starts to ramp up. I just wanted to add a couple of things about companies as well. Just just from chatting to people, what I've heard about some of the other benefits. Like Kristen says, they're the pretty exciting thing. One of the things that makes it exciting is it gives you real ownership in an actual actual psychological way. So I'm a big fan of multiple companies, and I have to stop mentioning them because I don't want to influence anyone. But there is nothing cooler than when you are having a conversation about a brand you really believe in. Christine, who works with us, I'll give you a shout out, Christine, really loves Lululemon. Other people really, really love Apple products. There's so many, I mean, Crocs, we just found out the other day, Crocs is listed on Hatch. So you actually have this actual ownership. And a couple of people have said to me, newer investors, they said it was such a light bulb moment for them when they realized they had been like buying Apple's products forever. And they'd never thought, why don't I own a slice of the company and then I actually benefit from all the people buying those products? And I think there's just that real sense of empowerment when you actually are a shareholder in a company that you really believe in, and you get voting rights often. So it's kind of cool. Like Kristen and I both voted Warren Buffett to stay leading his company the other day.
I don't know if our votes either way would have done much. But yeah, we did.
There's that, and I think the way I've started to put the companies versus funds is that kind of, and I think Kristen, you might go into it more, that kind of the set and forget, the bulk of your money, and that's for me, my purpose of investing is to continue my life traveling as much as possible, and this is to build my wealth so I can keep doing that. Terrible for the climate. I love it. And what that means is the bulk of my money is like building up so that I can do that. The companies I invest in are the ones that I really believe will do really, really well. So I've started to say they're the ones that are going to be the difference between flying economy or sometimes flying business class or premium economy. And if they don't do super well, they don't do super well. And that's no real difference. I still get to get the fundamentals of what I want to get out of investing, but they're the kind of like maybe a bit of a big win. So I think that's, for me, some of the other benefits of the two.
I'm going to tackle the tax question. So there are tax implications, but they're super, super simple and very straightforward with investing in US shares. So when you invest in US shares that are here in New Zealand, of which there are a couple funds that are wrapped up, you do pay taxes on them. It's just hidden from you because it's wrapped in a wrapper that's called pie, and they kind of do all that stuff in the background. But when you do get paid dividends here in New Zealand, you have to claim those on your IR3. And so it's actually no different in the US share markets. So if you're investing under $50,000 NZD in foreign investments, so that's any foreign share markets, you have to basically claim dividends. So that's assuming you're not a trader and you're investing for the long run. So you're not, day trading and that's your primary form of income and that's your job. You are investing for the long run. All you have to do is claim the dividends. We make it super easy you effectively just put your dividends that you got. Now you only have to claim over $200. So if you get less than $200 of dividends in a given year, you don't have to claim. And many companies, like I mentioned before, don't pay dividends. So if you're just investing in growth companies, it's probably not something you need to worry about come tax time. So again, that's under $50,000.
200 total of extra income.
Yeah, 200. Yeah, total. Sorry. Yeah.
Not just.
Sorry. So basically, with the under 50,000 is we give your tax reports at tax time, and we just give you one simple number that you have to put in your IR3, and it's super easy. Now, if you have invested over $50,000 in foreign investments, you kind of get caught up with something that's called FIF. And you basically just have to calculate your taxes in a slightly different way. There's two ways to calculate that. And the way we make that super simple is that we've connected to ShareSite, which is a local Wellington company that does that all for you. And effectively, once you're a Hatch member, you can basically turn that connection on. They get all of your transactions, and they can simply calculate for you. And there's two ways to do that. So I won't go into details because we had a really big tax webinar last night. If you want to have that, reach out to us, hello@hatchinvest.nz, and we'll send you a link to this tax webinar that we had. But all to say that I think that's another barrier that stops people from doing stuff, when really our job in technology is to actually make all that simple and remove all those barriers and make life simple so that you can just access the investments that you want to grow your wealth and get some freedom.
That, just to really, really clarify, once again, FIF rules any investment overseas. So if you've invested in a New Zealand listed fund or a New Zealand based fund that invests overseas, when you hit that 50,000 mark, you are still paying tax in the same way. It's once again, it's just hidden from you. So it's not like one way you pay tax and the other way you don't. So I think it's really, really important to just realize there's no getting out of paying tax ever.
We just make it, but we do make it simple, eh?
Yeah, absolutely.
Let's chat quickly about why Hatch over other people in the U.S. share markets. And I won't chat to other people, but I'll just tell you a little bit about Hatch. Hatch is part of the Kiwi Group family, so we're very well backed. We have huge shareholders. Our ownership goes all the way up to actually the Crown, ACC, and NZ Post. And they really are, investing in us and back what we're doing, and really believe in what we're doing. And so Hatch has got some fantastic shareholders, very strong team. Because we're part of the Kiwi Group family, we're actually, obliged to comply with some pretty strict regulations. And so things like we're part of the FSPR, which is basically a registry that we get put on when because of being a Kiwi company in the financial services, that if you've got any problems, you've got an avenue that escalates, that you can escalate. However, the one thing, we've got a huge Kiwi-based team that is really here to support you right from the get-go, from first-time investor and holding your hand to simply just letting you do your thing on our platform. We're available, kind of our hours. We say 9 to 5, but we probably work much longer hours and on the weekends as well. So anytime you reach out to support, you're going to get a human that is willing to chat to you and ready to help you with your problems. We've got some really high standards with supporting our Kiwi community, and so that's something that's very important to us. So you're backed by a great group of people. We really care a lot about, again, every step of the way in communicating to you. So that's from your deposit and booking your money to having it land in the US. We let you know all that stuff overseas, and we hold ourselves to a pretty, as along the way. And so that there's, it's not like things go into a black hole. And so I think we really pride ourselves, first of all, backed by a significant company, that's sizable, and we're here for the long term. Again, we hold ourselves really accountable to our basically our hatchlings is what we call our investors, and we go above and beyond to solve any problems. But as I said, there's all the kind of safeguards. We've done huge amount of due diligence on our partners to make sure that every step along the way is kind of safe as well. So we've done our best in that space. So we'll just leave it at that. Any other new?
I think there's only one about dealing in US shares, so I thought this would be a good time to just talk about the different ways people can invest through Hatch at the moment. So we've kind of found when we really launched thinking we'd attract this group of investors who were crying out for access to better investment opportunities. And we absolutely did. It's been so awesome being the first in New Zealand to make access to these global share markets accessible for average New Zealanders, for the everyday investor. And so we're really, really proud of that. And we got that first group on, and that's great, and they're up and running. But what we've actually found is that there's multiple different ways people have signed up and started using Hatch. And as over the last 2 years since we've launched, well, slightly less than 2 years, we've really started to evolve Hatch. So I can see that question, do you only deal in US shares? Absolutely, at the moment we do, but that's very, very much the beginning for us. Like I say, we're less than 2 years in, so we've got much, much bigger plans. But even with these share markets at the moment, with the 3,500 odd options, that what we've found is kind of we've grouped people into sort of 3 major groups of the behavior we see. And I think it's really important to highlight these, because I think even without thinking, most people have this idea in their head of what an investor looks like, and it's probably not what you'd imagine. So to start with, like Kristen says, we have this group of people who've never invested before, and we've invested really heavily ourselves in our Getting Started course, the free 10-day guide that jargon free and walks you through step by step. So it's, even if we found quite a few people who've bought shares before, it's such a good opportunity to take a step back, learn the fundamentals, really kind of get comfortable with jargon, we explain everything step by step. And we've had, I think, about 10,000 people do that course so far. So it's been thoroughly tested. And those people come in and what we found is they genuinely want to get a lot more confidence to get started. It's a totally new thing. They're faced with all these options. So we have a whole bunch of information to help people kind of make a start. And I really encourage you to get in touch if you want that. We'll post some links below, but we are more than happy to try and point you in the right direction. But with a lot of those investors, what we found is we kind of call it education money. Rather than thinking of starting as an investment, they think of starting as an education. So they might take something like $100, forget everything about fees and all the stuff that you're meant to care about when it comes to investing, and just consider that $100 the cost of an education, and they will back a company or maybe an industry or a trend that they really believe in. And that could be, like I say, Lululemon, because you really love the brand, you followed the marketing, you think that they have a point of difference that other people don't see, or that you think is going to continue to be a point of difference. Spotify is one that we've heard about a lot recently, where people are starting to go, what if they get into being a record label? I love Spotify. I see I can never skip through their ads on my free account. I've just upgraded. Other people must be upgrading. And that $100, if you consider it, or whatever, if you consider it education money instead of investing money, it kind of takes that. You're not investing, you're not trying to make a profit, you're just trying to learn. And that's what we've kind of found with that group, that a lot of people take that approach, and they sort of have the combination of really trying to get up to speed but doing it at the same time. Then we've got this whole group in the middle who we kind of call set and forget investors, the people who sign up and really take advantage of these 500 exchange traded funds we have and build a portfolio on this. They're the types who have their automatic payments set up from their bank account. Super easy to do through Hatch. You just have one little reference code you put in, and you can set it up however you like. Then you can set up an auto investment on Hatch, so you can browse all the different companies and ETFs, and when you place an order, you can set it up to be an automated order. And that really allows them to deposit money on their time frame to get in place really good financial habits. So if they're paid every week, they deposit every week. If it doesn't make sense for them to buy shares every week because they're depositing a smaller amount, they just set up the automatic payment, automatic investment to go through every month or every 3 months, and just leave that money stockpiling in Hatch. So that group's they tend to play around a little bit with buying a company or two, and they might add a couple, and they might really make use of our investors club, our closed community that's only open to people who've started investing through Hatch. So those, so that's a wealth of knowledge that they're sort of learning, but they're also busy people who like they're interested in a few things, but they're never going to spend, there's never going to be the biggest hobby in their life. They got other things to do. And then we've got our real hardcore investors, and these people are awesome, and they get really excited, and they're also some of our biggest contributors in our investors club. We love them dearly. A lot of them sign up.
They're very noisy. They're very noisy.
They're very noisy. Yeah, they are. But I mean, we have a few people who will take people through step by step various things and explain tax, and it's pretty cool. But these guys, yeah, and I say guys in the generic sense, there's a lot of women in there too. They really know their stuff, and they are analyzing companies, and they are debating and discussing. I'm part of a few messenger groups with Hatch investors talking about their different strategies and that sort of stuff. And I suppose, the sort of long story short, really there is no one way to invest, and I think that's also the case when it comes to advice and how to analyze investments and that sort of stuff. There is no one way. There's multiple ways that work, and the idea that you have to prescribe, there's one prescribed way to be successful, is really outdated. You can use Hatch however you like, and you can rely on the community, and you can ask us questions, but there's absolutely no right or wrong way. And that's just the three broad groups. There's a ton of other people who have, I mean, a lot of people are sitting around the family dinner table at night discussing options with their kids. Like everyone can invest in the way they want to invest, and there's no right or wrong way.
I'll take us through a little Hatch 101 just very quickly. So if you haven't signed up for Hatch or verified, it just takes a few minutes. You just need a driver's license or a passport. We're accepting foreign passports as well. So really easy to sign up. And then you can, when you're ready, you can watch list and you can just watch if you want to do the course and just take your time to watch things. And when you feel ready, we do our banking currently at 2 o'clock and at 4:30 every day. So we usually just say, look, if you pop your money in the morning, it'll get to your, basically what we do is we batch up everyone's money. We book it in at a foreign exchange rate at around 2:30 and 3 o'clock, and then again at 4:30. So that's just something to keep in mind, which is why we often have a lot of people just checking the exchange rate in the morning, and we've got it really simply on the deposit page, putting money across in the morning, and effectively money as US dollars will land in your Hatch account at around 1:30 a.m., which is when the markets open. So you're most welcome to wake up and do anything in the middle of the night, or the following morning wake up a little bit early, or you can place, if you've got money in your Hatch account, you can place orders, and when the markets open, that order will go through at that opening share price. And so we've tried to keep things pretty simple. We're looking at speeding up the deposit process. So that's something, and having really fast deposits, that's something we're working with our US broker on doing. We're also looking at USD. We know a lot of customers come to us and they say, I've got a US dollar account. And so we're looking at opening up a US bank account in the United States where we can basically just, push US dollars across, because we recognize that there's people doing that as well. And so that's kind of getting money in. Buying and selling happens automatically when the markets are open, or as I said before, orders are kind of held. And there's a few different ways that you can order. You can do a market order, which is basically just automatic when the markets are open. You can place a limit order where you're saying, look, I only want to buy Tesla, but only if it's $400. So I'm going to set it, and when it hits that $400, my order is put through. And then there's stop loss, which I'm not going to go into tonight, but it's more of a probably more of someone who's really confident.
It's basically an insurance policy. It's to say, I don't want
shares fall below a certain level. Sell them. But if you're in it for the long run, most people tend to ride it out. And those would be kind of those investors, that third group that Nat was talking about. But for the most part, if you're kind of really backing a business or just a wider fund or a market, you tend just to kind of ride out those bumps, like I said, and not panic. And so that's kind of a Hatch. We're looking at adding, right now you can sign up as an individual or a trust. We're looking at potentially looking at joint accounts in the future, but the first thing we want to do is kids portfolios. So that's something that's going in. Nat has designed it. It's something that's going in to build soon. So we hope to have kids portfolios. Right now I'm investing for my kids into shares that they know and love. I've got, my son's got Nike and Apple. My daughter has Disney and Netflix. And when we get those kids portfolios, I can just do an off-market transfer into their own share portfolios. So kids accounts are coming soon. We're looking at some funds, because we've talked about, again, having kind of that set and forget, and then doing kind of the fun stuff, which is really engaging, and again, backing the things that you truly believe in. And so we're looking at some different types of funds, including some New Zealand ones. So hope to look to that. And other markets in the future. But we don't want to go down, too narrow with shares, because that's just one portion of, wealth building. And so when we think about this money platform and wanting, Kiwis to up their wealth, that has to include short-term savings. And so, savings accounts and TDs are, they're not ideal at the moment. They're not offering you a lot of returns. So we want to look at, what would that look like? A really interesting product that is sitting in Hatch, that has your money working for you rather than just sitting and doing nothing, but maybe not quite as risky as the share market. So looking at that and other stuff in the future. So some of those things coming on. Let's talk quickly about the markets and the best time to invest. And then I'm going to let Nat touch that one too, as well. Is that okay? Can we talk about that?
Yeah.
Okay. So it's interesting. Like I said, we had a lot of people coming in off the sidelines when the markets dropped. And that's fantastic. They've seen a huge upswing. Shares have come back significantly. But I think a lot of analysts are expecting volatility, but humans are really bad at timing that. So I'm watched CNBC every morning when I work and from home. And I just find that every morning it's the same thing. It's like, oh, the share markets were either up or they were down overnight. And there's an explanation. So it has to do with a vaccine, or it has to do with something Trump said. And but the thing is they're telling us what happened in the past. They're not able to say what's going to happen in the future. We know that the economy isn't in a great position. We recognize that. The share markets seem a little bit divorced from it at the moment. But we also know that eventually the economy is going to recover, and eventually we're going to get a vaccine, we hope. And so if you look at the share markets over the long run, same with the GFC, no one could really time the bottom and time when the markets were going to come back. And again, if you sit on the sidelines too long and you kind of miss that upswing, you kind of are missing the markets recovering. And yes, they're volatile in the short term. But again, over a long period of time, humans tend to just have to wait and ride out those bumps, because very, very rarely, and this is including investors that do this for a living, are they able to time the market and know when to get in and when to get out, which is why, again, it's that concept of when's the best time to invest, and it's actually yesterday, and the second best time to invest is today, irregardless of what's happening in the markets. Just getting your money working for you, starting to learn, starting to engage with your wealth is just super, super important. So I'll leave it at that. Nat, thoughts?
Yeah, I suppose the only thing I'd add is one of the other, I would say, big advantages of Hatch and our backing is that we are in this for the next 20 years with you. We're not interested in making a quick buck. So there is no benefit to us for you jump in now, panic buy now, and have a really bad experience. So if you are unsure and you think you're not going to be able to sleep at night if you have money sitting in the markets, then it's absolutely your prerogative to hold off. But I also completely agree with what Kristen said. And there's actually, we're going to have to post a bunch of stuff, but there was a really good study someone did on what if someone had missed the 5 best days of the market, and because they tried to time it, and it's amazing. I think their returns, were like 20% or 50% less or something. So it is really that they often say it's time in the market, not timing the market. I think the other thing that with the economic situation, going back to this concept of buying businesses rather than trading stocks is absolutely in the short term. And actually, to be fair, I don't think it's just the short term now. There have been huge amounts of volatility in the markets forever. Even last year, which was a brilliant year in terms of the overall returns, there were days where the markets or particular companies would be up and down by 10%. They're a volatile place. They're huge. The scale of them is mind-blowing. So you will always have volatility. But when you're investing in a business or in a trend, like Kristen mentioned before, cannabis, some of the other exchange-traded funds we have is things like robotics or even female leaders. There's a million things that I've started to dig into them. Healthcare, biotech, all that sort of stuff. If you really, really believe in that industry or that company, does the short-term volatility make a difference? For me, I'm thinking in 20 years' time, Apple's share price in the short term might be like this, especially in the coming months. Is it still a good business? I think so. So I think that's kind of the way I look at it. And then one of the things I just wanted to add to this, because I feel like it was kind of a strong theme that came through from the people who answered our questions and from the people we've spoken to, is that most people delay starting because they just don't think they know enough. And I think all these other barriers like the foreign markets and the tax and that sort of stuff just boils down to this feeling of like, I just don't know enough. So I suppose I've got a little secret for you that no one does. There's no such thing as anyone who's psychic, who understands, and even the best investors, like we've talked a little bit about Warren Buffett, he's having a bad year. One of the best investors who's ever lived is not having a great time at the moment. He invested in airlines when they're at their peak and suddenly they're all going bankrupt. So I feel like that idea that, and I know Kristen and I talk about this a bit, women especially can be particularly bad at this. We don't want to start doing something till we're 110% confident we know what we're doing. But you're never going to know exactly what you're doing. Even if you talk to some of our investors, which we do very regularly, who've been investing for 20 years. I've been investing for 15 odd. My sister who's listening has probably been investing the same time. We would not consider ourselves experts. It's another thing, the more you learn, the more you realize how little you know. I feel like that kind of going back to those core principles of backing businesses that you believe in for the long term, and just investing amounts that you don't think you're going to need to get out in the near future. And even if you want them in 10 years, you could actually delay another 5 years. You can really sort of kind of push past this stuff, but everything changes if you don't think you can sleep at night, or if you feel like you're going to panic sell at the wrong time. Then I think that that's the time to really just sort of take a step back and make sure that you're really comfortable with what you're doing.
Right on. I will just leave it with, because we've got kind of it's 7 o'clock. So I'm just going to leave it with those that are just getting started. Feel free to do the Getting Started course. If you want to start researching companies, if you want to invest in individual companies, there's some fantastic sites. Our weekly newsletter is a fantastic resource. We've written lots of blogs on how you might do that. Motley Fool is a pretty cool resource. Finimize is a great US newsletter you can sign up to, but just get a sense of how strong these companies are. I would certainly recommend, if you're investing in individual companies, make sure you understand how they make money, how big, their growth prospects are. So they have growing customer base. Do they have cash on hand, to weather kind of these bumps that we've got ahead in the economy. So certainly empower yourselves to learn a little bit when you're getting into companies. We'll leave it at that. And we've got a few more questions coming in. So I think what we'll do is, can we answer them on YouTube, Nat? Because we'll just sign off. Sure, people want to go and get their wines and watch their shows. Can we answer them on YouTube? I think we can.
I think we can just write comments. There is one, I think there's one about tax, and we'll just post a link to the other webinar. We did a really thorough one with some great experts last night, so it's well worth a listen. But I think we should wrap up. We're not going to hold you any later. We're running these more regularly, so we'll have more.
Yeah, we will. We will. And so we'll try and answer the ones we didn't get to, or reach out to hello@hatchinvest.nz with them, and we're happy to do that. So thanks so much, everyone, for joining. I'm Kristen. Hope you had a nice time with Nat and myself, and we look forward to chatting again soon. Have a good night.
Everyone.